Welcome to the B.F. Anderson Technical Report for August 26th. We've got Jackson Hole Thursday. Fed will be making some announcements. Let's just kind of take a quick snapshot of a couple of economic factors to be aware of. You know, the Fed has a double mandate. One, they've got to keep the employment rate under control, and they also have to keep inflation under control. So it's kind of a balancing act. Well, as you can see right now with the employment rate, we're just seeing really positive results here. This is also initial unemployment claims going down. Now, we are seeing confidence. Consumer confidence has been, somewhat up. Home prices are up. So those are things that are, inflationary. And we do know that the PPI and the CPI are in pretty much record territory. But let's just see if they know what they're doing. Hopefully we get to a balance of the two, or really of the four. Now, as we get into the markets, you can see here NASDAQ breaking out new highs, looks very positive. Here we have the long-term graph on the, it's actually a weekly graph, but it shows a 35-week moving average. Very positive pattern. Mid-caps are starting to get a little bit of improvement here. Now, here's been the old problem is that we're seeing certain sectors of the market lead this market, but in a way they're playing catch-up, in my opinion, because last year, meaning 2020, the growth stocks really outperformed. And so, things like Tesla, Roku, etc. In the meantime, the consumer staple stocks, the tobacco stocks, the beer stocks, the utilities, the banks, things like that lagged behind, so they're playing catch up here. Well, this is kind of what we're seeing here, though, is the market could be broadening out a little bit more. New York Composite still kind of stuck in a sideways motion. However, we are seeing somewhat of a buy signal here as it comes up through that 10-day moving average and breaks above that base. Here we have the small caps, really need to see some improvement there. We'll talk a little bit more about that as we get into the video. Large caps, as far as the S&P 500, again, just like the NASDAQ, and we've been seeing this pretty much all year. The S&P, NASDAQ outperforming, everything else not. So, there are 8,000 publicly traded companies approximately. This index only measures 500 of them, but they really are probably 500 of some of the best companies in the country. So here's the long-term graph. Again, very constructive, no problem. I think we're definitely in a bull market here. Now, important. This is the aggression index. Again, it's where I'm measuring basically NASDAQ or technology-type stocks or growth stocks, and I'm comparing it to old-time consumer staples, things like toothpaste, tobacco, beer, that kind of thing. These stocks have been outperforming the market so far this year. These stocks have been underperforming. As you can see here, around February, when the line goes down, the growth stocks are underperforming. However, we're starting to see some stabilization in here. I'm going to take you back in time because we did not get a sell signal. It actually came down right to the 40 week. Here's the 40 week here. We held, rallied, and we held. Now, if we can break above 210, 212, on this ratio, I do think that's going to be a higher high after, somewhat of a consolidation, somewhat of a breakout. So I think this is important. We're going to talk more about this. Now, on the three economic indicators, you've got the Treasury note continuing to hover around the 200-day moving average, currently at 1.3. I'll mention this. I've been monitoring the mortgage market. And the mortgage market right now, 15-year mortgages are going for around 2%, which is record lows. This is going to be very stimulative to the economy. Now, here's oil kind of after being somewhat in a downtrend, getting a bounce. Financial stocks with the upturn in interest rates, you're seeing a little bit of upturn there. Now, on new lows, little troubling. Now, new lows, just like sentiment, is a secondary indicator. The primary indicator is the trend, which we start out with every one of these sessions. Now, with the new lows, you're starting to see what I would call an eyebrow-raising situation. We're getting too many new lows as the market continues to make new highs. Hopefully that settles back down. We'll see. Now, no inversion on the inverted yield curve. As you can see, every inversion has pretty much predicted recession. However, we're moving in the wrong direction because rates are just kind of on the low end, but we're not in an inversion, so don't overestimate. Sentiment is definitely improving. We're seeing the AAII sentiment ratio getting back into negative territory. This means that the bears are starting to outnumber the bulls. That's good because we want to see a little bit of fear out there. We don't want some red hot, everybody party type of situation like they had in 1928, 1929. We don't want that. Now, the institutional sentiment readings continue to stay stuck in greed. We're not seeing much change there. Again, these are secondary indicators. Now, I think this is an important graph. This is the Russell 2000 Growth ETF. This is growth stocks. Now, as you can see here, we rallied up to a high on February the 10th, came way down, held this base, rallied back up, held, rallied back up, held, rallied back up, held. So it's kind of like, I like growth stocks here, I don't like growth stocks here. I really like growth stocks here. So what we're seeing here is a consolidation of a group of stocks. Now, we've gone down and tested this lower end 1, 2, 3, 4, 5 times, which is a lot. And on this last rally, it was somewhat anemic. However, if we can break out of this base, and I really mean like 315, 320, I think it could be very meaningful. Now, on junk bonds, again, this is somewhat of a secondary indicator as well. I'm comparing junk bonds to treasury bonds. When the line's going down, it's telling you that junk bonds are underperforming, which is somewhat of a fear of economic problems. However, we broke the 200-day, rallied back up, came back. Now we've tested this area 3 times, and we're now breaking back above the 200-day. Again, this is just an eyebrow-raising indicator. Now, on the volatility index, we're seeing a lot of stability in the market, actually, not having a problem with the VIX at all. Now, this is interesting because I've been talking about growth stocks. What is leading this market? Well, let's start off with consumer staples. You can see here that these defensive type stocks are looking a little too good. Now, will that change? We don't know. But I know in the long run, buying the old companies, the old Campbell Soup type companies and Kellogg Corn Flakes, I just don't think you're going to come out like you would with good, solid growth stocks. Now, here is the utility stocks. Again, you can see an uptrend really since around February, March. This is insurance companies. You can see the uptrend. Now, if you look down here at the very bottom, I've got the IWO, which is the Russell 2000 Growth. You can see it has basically gone nowhere while these stocks have continued to outperform. So the question is, should I jump out of growth stocks and go into defensive type consumer staple stocks? Well, I'll put it this way. My experience has been you jump out of one, go into another, then the one that you jump into starts underperforming, and the one you're jumping out of starts outperforming. So go figure that. Now, on kind of a long-term look at this thing, which is the aggression index, I wanted to mention this. I went back to 2007, and I took the 40-week moving average and the 10-week moving average, and basically you can see here when the aggression index drastically breaks through that lower moving average, meaning that 40-week moving average, at least in 2007, it would have told you to get your ears up. This market is turning over and looking bad because, like I say, the old-timey stuff is not going to cause the economy to grow. It's not. We need new growth stocks. So as the growth stocks really deteriorate like they did back in 08 and 09, the market dropped about 55% in that time period. So what I'm saying is the aggression index, I believe, is an important indicator that could give us a heads up when things are really starting to turn south. Now let's get into the top 5. Here's Asana, which is software. Again, I've told you the software business is really booming. We're seeing a lot of software stocks. These are all subscription-based business models, which means like a magazine subscription. You got to pay for it every year or every month or whatever, like getting the newspaper. Now, Lending Club, which is a financial situation, as you can see here. Now remember here, the purpose of the top 5 is just to kind of give us an idea of which stocks are out there that are really acting interesting. But also we can use it as a way to have lessons on technical patterns. So here we have on Lending Club, what's interesting here is notice this volume, and then you get what you call a gap up. That means the institutions are coming into this stock. So it gapped up, started another uptrend, pulled back, kind of tried to violate in here but didn't, and pulled back up again. So it continues to look good. Here's Nucor, which is steel. Again, another gap up, somewhat of a failing flag formation, but breaking out back above that 10 days, so that's positive. NVIDIA is very strong. This is one of the strongest technology stocks in the market. Look, I'm thinking about this thing as possibly another Apple or another Intel or another big player. These guys are just are very smart. So as you can see here, the stock formed a really nice base, broke out of that base, is doing it on high volume, which tells you what you're looking for. NVIDIA looks very positive. Sprout Social. This is a company, it's basically somewhat of an advertising agency, helps people with their advertising on Google and Facebook and all the different things. But you can see here, again, gap up, kind of a failing flag, held the lower end of the flag, and then started to rally again. So this one looks very good, actually. And the volume is coming in. It's not above average, but it's okay. So that's it. If you have any questions, please let me know. Thank you very much.